Hello, Greg Kuda.
Hey, Mike. How are you?
I'm doing well, and yourself?
I am doing well. Kind of a slow day in lumber. Slow last couple of days.
Yeah, you know what? I mean, I was sitting here thinking about that as well. Hey, guess what? Everything's going to change in like 2 weeks. You want to trade today?
Yeah, I think you're seeing it's pretty evident with the change in open interest now. When this was announced, to see, at one point we were up over 2,500. Today we're, I think, 1881. So I think a lot of traders, like it or not, are going to the sidelines here.
Well, and um, summer has started early in other industries. It doesn't surprise me. August is always a slow month, but if you are coming into a slow period with change, everyone's going to be like, wait a minute, we want to see how this plays out.
Yeah, absolutely. I think you're definitely seeing that with the funds, where I don't know what's changed fundamentally. If anything, the news out there is probably less favorable to be pro-housing, and yet the funds continue to liquidate their position. So I think it has a lot to do with this new contract here.
Which, I mean, it makes sense. It's not a shock. All right, are we almost noon here?
I think we are high noon right now.
High noon. Well, we had our housing start number came out today.
Yeah, I've got I got that. I've got obviously the update on the CME webinar that starts today, and then the other big news was the potential takeover of West Fraser. I don't know if you saw that.
I did. It's that is kind of interesting. Uh,
Yeah.
all right, let's kick it off here. Hello, everyone. It is
Hello.
July 19th, Tuesday. Lumber futures from the free seats. We have Greg Kuda, Westline Capital Management, with us. I'm Mike Wisniewski with Materials Exchange, and let's talk some lumber futures. Lots
Let's
going
do
on.
it. Hello, everybody. So the big thing that Mike and I want to remind everybody is that the CME is doing a 5-part webinar that starts today, that will go over all aspects of the new contract. We highly encourage everybody and anybody, if you don't trade, if you currently trade, if you're thinking about trading, if you're a spec, if you're a hedge, all of the above, to participate in this webinar. More importantly, you get to ask questions. And so instead of my interpretation, Mike's interpretation,
Yeah,
you
right.
can speak with the people that actually wrote this contract. Like I know today, lumber deliveries, Laura Bushneys, who is head of CME deliveries, not just for lumber, but for all physical deliveries at the CME, will be on today's webinar. You can ask her directly specific questions. She's the one that wrote the delivery verbiage in this new contract. Please, there you go. I see you guys posted it. You have to register. I do know that these will be recorded. So if you can't watch it live, you will be able to watch the recordings. And definitely whether you can
Where can
ask.
you register? I'm
So if you look at the bottom, if you click on that, I don't know if Jory just posted a link, but at the bottom of that, I'm assuming it's the link she just
Oh,
posted.
there we
It
go.
gives you
Okay.
the little blue box that says register here.
There
So I
it is.
know the first one's today, the next one's on Thursday, and then you have 2 next week, and then the final one is August 2nd. So please watch.
Jory, I'm just gonna find Jory for a second. Hey, Jory, where did we find this link? Jory, you're live. You can talk. Actually, you're on mute though.
It's the link is right on the CME's website.
It is on their.
If you have oops, hang on, I'm trying to.
Yeah, I tried to find it on their website. All right. I tell you what, when Jory finds it on the,
But I put it on LinkedIn, so anyone can just click on it.
okay, so go to our LinkedIn
Go
page.
to our LinkedIn page, and you can see the page.
All right, perfect. All right, thank you very much, Jory.
You're welcome.
All right, so yeah, the delivery thing, it's such an important discussion for something that never happens.
Yeah, no, and it's one of those things. It's a necessary evil, in that less than 1% of the time, it's likely to happen. But because it's a deliverable contract, the CME has to spell this out in exhaustive detail on how the delivery aspect would work for both the buy and the sell side. So I think the relevant ones are obviously going to be the EFP component on Thursday. I think part 3, which is next week, matching algorithms and their impacts. They're going to tell you, you get these limit up, limit down days, and we all think it's algo driven. They're going to go into great detail on how the algorithms trade on the CME platform. So I think that'll be good. And then obviously the idea of this being a circuit breaker contract versus the daily limit. And then last but not least, the conversion of existing contracts into the new contract via the spread. But I know we hit upon this last week, Mike, the idea that the existing contract, the legacy contract, is still going to have pre-existing limits. The new contract's going to have that circuit breaker. And the rationale behind this is the existing contract is FOB Prince George. The new contract will be FOB Chicago. So you're going to have 2 different numbers. When you look at September, or realistically November, with the new contract, it's going to reflect a number delivered to Chicago versus the existing contract, which is going to still reflect FOB Prince George.
Yeah, I think everything's going to roll pretty quickly to the new contract, but we will see.
Yeah. So that's that. Please register. Please join in. Ask the CME lots of questions. This benefits everybody when the industry participates. The next big thing out there this morning was that CVC and Chronospan, in a joint bid to take over West Fraser. What you're reading here is what we know. I know RBC just put something out that Chronospan already has a 9.4% stake in West Fraser, but this will be interesting to see how this plays out, in that we all know Fraser's flush with cash. So, the stock, as of the last time I checked, West Fraser stock was up somewhere around 18% from yesterday's close off of this news.
And I think what's interesting about that is Chronospan is privately held, and CVC is a private equity company. So This is going to be an all cash deal, most likely, if it goes through.
Yeah, absolutely. So obviously, as the details come out of this, we'll forward it on. And then obviously, Fraser has their conference call, I think the 27th of July. So I'm sure there's going to be lots of questions asked with that conference call on their earnings here. Let's jump into normal type stuff. The big takeaway week over week is interest rates have kind of settled down. Energies seemingly have found a bottom for the time being. Equities are attempting to rally. The Dow's up somewhere around 400 plus right now, close to 500. And so lumber has kind of gone sideways. And, when we jump into the next, I'll go over this real quickly. If you look at the last month, we've looked at these performance numbers for the different sectors of the S&P 500. And year to date, since last fall, the laggards have been the biggest positive performers here over the last month. Look at the top here, home building. I think you can see real estate here. What were some of the other ones here? Trucking, household appliances. You've seen a nice bounce back in all of these over the last month or so. And the ones that had been the leaders to the upside, like energies, agricultural products, fertilizer, they're all toward the bottom here over the last month. So you've kind of
Yeah.
had this rotation shift back into the week. All of a sudden, home building's no longer at the bottom of the barrel here.
Yeah, it's a little move back to the mean a bit.
Yeah, exactly. So when you look at commodities as a whole, you're definitely seeing an attempt to bottom. More so, and I think energies. Some of these other markets are still kind of struggling, but the big takeaway for me is that the dollar is attempting to top out, and with that, you're at least getting a relief rally in physical commodities right now. And so when we look at over the last 5 days, we'll just run through these because I know we want to get to lumber and housing. Last 5 days, you've had a relief rally in Bitcoin, in crude oil, and some of the other physical commodities. Here's NASDAQ, here's S&P, versus the last 5 days, the laggards. Unfortunately, lumber, after being up in that 745, 750 area a week and a half ago, lumber's given a big chunk of that back. We'll see that in the basis charts here later in the slide deck. And so when you look at future, this is since the beginning of April, basically, you can see that kind of physical commodities have struggled here. Good old lumber is the dark gray, and you can see how we always talk about lumber being a leading indicator, even more so than copper. And you can see lumber kind of led the charge to the downside here, and everything else followed suit. And so now we're trying to stabilize and at least attempt to put in bottoms on all these different markets here. The big headlines last week, Mike, were CPI, PPI, and when you look at CPI, housing is just over 7% inflation on an annualized basis. All other items are in that 9.1% area. So that was the big headline last week, that both CPI and PPI were a surprise to the upside. And then when we break this down, I'm not going to, anybody who wants this slide deck, will forward this on. But you can see, just look at these columns here. Look at these categories, and this is all from the government's website. You can see on an annualized basis, there is inflation in just about every sector out there. And when you break it down, gas, so what do people use? They use food, they use energy. So again, gasoline up 60%, electricity up 14%, utility gas up 38%. You go into food, everybody goes to the store. Fruit and vegetables up 8%. You get some of these other ones like cereal, 14%. A lot of this probably with inputs like fertilizer and feed costs going up. So there's lots of inflation when you look at core goods, non-core goods. There's inflation all around right now. We'll jump into lumber now. I thought this was interesting. Here is monthly change in softwood lumber prices, 1947 to 2022. I'm not sure what what they're following in 1947. I don't know what the underlying data points are, but I think it's just interesting when you look at, we know, we've all experienced the volatility firsthand, but you can really see it on this historically when you look at the last 2.5 years or so, just the wild gyrations back and forth. And when you look at, so when we look at inflation, CPI, PPI, and how it impacts home building, so here's change in building materials, and we know that lumber is off anywhere in the neighborhood, let's say, of 19 to 22% off of its highs. But a lot of other commodities that are utilized in construction and home building, they have not seen that kind of pullback. Here's ready-mix concrete prices. Here's gypsum board prices. Here's steel mill prices. So we're still trending upwards with really no sign of, maybe with outside of steel, putting at a top. And then you look at some of these other goods that go into building materials. Here's millwork prices. goods used in residential maintenance and repair, asphalt, tar, roofing, construction materials. And look at that year over year increase in pricing. So, as much as we want to say that lumber is a leading indicator, you're not necessarily seeing that pullback in other building materials right now, at least not yet. So inputs to
Well,
build a house are still highly expensive outside of lumber.
we do know that gypsum is the biggest boom bust industry there is.
Yeah, yeah.
Their inflexibility to match the supply and demand is a well-known fact.
Yeah, no, absolutely. Absolutely. And so then when we jump into change in freight transportation prices, look at trucking, year over year, you're up over 10%. Since January of 20, just staggering numbers, staggering totals as far as just shipping goods. So getting goods from point A to point B, also gets baked into the cake as far as how expensive things are. So then, yesterday we had the NHAB housing market index. Today we had housing starts. When you look at the housing market index, you had the drop of 12 points to a level of 55, largest drop in HMI builder sentiment in the history of the index, with the exception of April 2020, which was pandemic. So bearish sentiment is creeping into builder sentiment, to say the least. And then when you get into housing starts, what came out today, they were kind of within line of forecast estimates. But, I know we've referenced this chart before, Mike, and we had building permits, 1 point over 1.8 something, housing starts over 1.7 something. That housing completions number just can't seem to get off the mat here. And so we talked about this convergence that would take place, and slowly but surely permits and starts are falling back to earth. You can only, again, grow what you can complete, and completions still seem to be a real struggle. Here's housing starts. So again, the high water mark with starts back in April, 1.805, back down under 1.6 now. And then with permits, high water mark was 1.896. This is back in December, and then 1.879 back in March, back under 1.7 now, 2 months in a row. So you're definitely converging back to what you can actually complete. So the big beneficiary of the destruction of single family becomes the multi, and you can see this with year over year rent growth. So these are rent cost year over year in different cities. So obviously people need to live somewhere. So instead of buying a home, you're going into multifamily rental type opportunities. And so this is where you're seeing that continued inflation rear its ugly head, where you can't buy a home, you still have to rent. So you see landlords taking full advantage of the ability to raise prices on renters there year over year.
Yep. I mean, we got to live somewhere. That's for
Yeah,
sure.
yeah.
And we know that we've been underbuilt.
So I thought this was interesting. Mortgage rates. We've talked about this, how mortgage rates, whether you're talking about 30-year and even the 10-year, have been leading indicators. The Fed has been behind the 8 ball, and markets have kind of set the tone for what lies ahead. And you can see, I thought this is really good. When you look at mortgage rates, how you've had this bump up off of 3%, you started to see this uptick in interest rates well in advance of when the Fed finally decided to raise rates, where your interest rate structure, your yield curve, was definitely a leading indicator that forced the Fed's hand here. Everybody saw it before you actually saw the increase in Fed funds. And so the expectation, we have another FOMC meeting.
The big deal here, though, is that mortgage is a 30-year money. Well, realistically, I think what they think mortgages are about a 17-year.
Yeah.
Somewhere between 10 and 20. Fed funds is overnight. So you're talking like, the borrowing cost to borrow overnight versus for 17 years.
Yeah, no, and that's the amazing part. Yeah, no, absolutely. Where, you see it Okay, these are rate hikes, cuts in the past 30 years. You got a nice kind of bell curve here. So the last 0.75 increase was obviously last month. You know, Bank of Canada raised a full basis point in their last meeting. When you look at Fed Fund futures, you're definitely building in 100% chance of a 0.75 increase at the end of this month. Do we dare see uh, um, a full basis point increase? And it's a possibility. We've never had it before.
I think it is a very remote possibility. The one thing the Fed does is they want to keep their credibility, and the talking points or the chirping from the Fed is no, we're not going 1, we're going 7.5.
Yeah, and I think you'll see 0.75 the next 2 months, and then you'll get above 3% on the Fed fund rate, and then they'll reassess from that point.
Yep.
So we'll jump into lumber here, but I thought this was interesting. Here's your world economy, global GDP, and it gives you perspective on how big the United States and China are relative to everybody else. For being in the news so much, you can see how insignificant Russia is, but the havoc they can create in Europe, here's Europe, is
Right,
pretty substantial.
The important part of that slide is the size of Europe is about the size of the United States.
Yep.
From an economy standpoint, and they're in the midst of a massive energy crisis, and it's all because of the gas flow coming out of Russia.
Yeah, no, and Russia's fully aware of this and what the damage to be able to, the instability that they can wreak havoc here, and that's definitely the end game right now. So we'll jump into lumber. I know people have been asking me. We know that the duty is going to change here. My understanding is it gets filed on the 2nd or 3rd of August. And so these are existing rates right now. I'm sorry, these are the existing rates, this bottom square right here. This is what exists today. This is going to be the new rate. So you can see Canfor is the big winner in going from 19.54% to 6.75. Fraser will go up slightly. Resolute will go down, but they're still the high man on the totem pole as far as paying the highest duty. And then you have JD Irving and all others. But this is the preliminary rates. This will actually be filed the beginning of August, and then that's when they become final and then implemented. So once we have a very specific date, once that's filed, we'll publish all that information.
Okay.
So we know July expired last week at 682. There ended up being a total of 221 EFPs. There really weren't that many fireworks going into the close, as the vast majority of Julys were EFP'd. There's still one left on the books that ultimately will be EFP'd. So here's July expiration right here at 682. September obviously is trading at a discount to July expiration. So do we go, what's the upside potential here? How quickly can this market go fill the 682 area versus slip sliding away? Trend line support is going to put you somewhere into this, and we've seen September now trade back down into the low 620s last week. The low today was 628.20. So we're seeing that scenario where futures is at a discount to physical cash. Mills are somewhere in the, call it a 665 to 675 area. So here's your SEP daily chart. You've got a triangle coil formation where, you're going to go sideways, or you're going to get some kind of a breakout, the upside breakout. Again, this gap right here is about a 670. You've got the July expiration at 682. So that's kind of your upside potential, a breakout to the downside. Really would, if you were to retest these lows here, which is like a 618, then it would open up this ball, potentially that 600 to 575 to 550 area.
Yep. And I mean, my target there is the low back in.
Yeah.
And then if you go back to the continuation chart I think you just had up. Yeah, and you're back, whatever those 454.
Yeah,
That
and
back
it's
breaking the last
interesting.
year.
It's something I can't show, but it's interesting to get people's take on break-even scenarios for the different sectors, North American producing sectors. I'm hearing stuff as high as 600 to 650 in British Columbia. I know one of the major publications out there thinks it's down in the sub 550 to 5.25 area. But that's definitely the highest cost of production. When you get into Quebec, you get into Ontario, you get into inland U.S., you get into the southern U.S. You're well into the 400s to potentially sub 300, depending on those producing regions. So the idea that you can't go down to these numbers, now you could easily float back to historical type mean pricing in all species as well as lumber futures. This isn't a foregone conclusion. You just have to stay here, and this is good enough.
Yeah, and look, OSB, which we don't really talk about that much or that often. I mean, that's got a 3 handle. Starts with a 3 in many cases.
Yeah, absolutely. And you guys see that firsthand
716.
with all the trucks that trade on MX. So SEP-NOV, kind of a similar wedge type formation where best case scenario, the spread would trade back out to the 20 over area. If you break down from here, you could easily unravel and go test this negative 25 area again. And then when you look at the curve, and again, this was as of yesterday's close, but interestingly enough, you've got cash way up here in the 675 area, 665, 675 area. And then you've got this structure in place where you've got these deep discounts in SEP-NOV. And you see this, so the basis, here's the September basis as of last Tuesday. Cash was trading at a $56 discount to futures. Fast forward, and we've had a big corrective move in September to the downside to where cash is now trading $29 over September. So futures is at a discount, but our people, it doesn't seem like there's this sense of urgency to own much of anything right now. People are doing what they have to do. And I don't see evidence of any type of inventory accumulation, whether futures or cash. You're definitely not seeing it in futures with the liquidating structure. Here's November. Again, cash is trading at a $27 discount. I'm sorry, cash is trading at a $27 premium to November. So to equate futures to cash, you almost have to go out to March to trade at a premium to where physical cash is or where the mills are asking today, which is kind of interesting that if there was this big sense of urgency, you would think people would be gobbling this September and November contract up. You'd see a build of open interest in these months, but like we talked about before, Mike, the reality is there's more comfort to liquidate in anticipation of the new contract right now.
Well, I just think that everyone is afraid of the scarcity of product, and they pre-planned. So I think a lot of this business is already covered. The wood needs to ship, right? But the business has been covered.
Yeah, and I think when you think of housing starts in the anticipation of, I'll go back to, when you look at housing completions and this 1.3 something, and when we had permits and starts at these high-end numbers, there was a lot of business that was put on the books. And in anticipation of this stuff, you know it's out there, you know it's going to transact. It's just a question of time. So I think, I think people had planned, and there doesn't seem to be a shortage of wood in the pipeline. And just kind of making the rounds earlier today, we know that rail has been an ongoing issue, and asking people, well, I've got maybe 1 or 2 guys with wood that was purchased in June that still hasn't shipped. The vast majority of people out there, the latest they're seeing wood not shipping now is the week of the 4th of July. So it definitely feels like rail is finally catching up to actual, when stuff was purchased versus shipping now. So then if we go to the basis, open interest a week ago. So 2 weeks ago, this number was in the 2250, 2300. Last week, it was just above 2000. Fast forward to today, we're 1881. So we're just shedding, and you see it with the CFTC numbers. Managed money is liquidating. Again, at the high water mark, this is somewhere around 765. You on the strength, recent strength in September, you saw liquidation profit taking to the upside. You saw people selling, commercial selling, but the other big one here, swap dealer shorts, this liquidation of just all around to take us down to 1880 again in open interest.
I find the most interesting number there is the producer merchant short position. Like that, the industry's not hedged all in.
No.
Like
No.
the industry seems to have zero fear of lower prices.
Yeah, which is pretty amazing. It's again, that and this managed money component where, fundamentally, I'm not sure technically what's really changed to drive these guys out. I think the reality is it's just this new contract, and we're just gonna reassess once we start trading, and then figure out the liquidity and go from there. Last thing, just the rail situation. You're definitely seeing an improvement in car velocity. And then the only other thing of interest here is you see Canadian traffic definitely seems to be improving, while U.S. traffic seems to be worsening. So I'm not sure, kind of how to interpret that, where wood seems to be flowing better coming out of Canada and then stumbling in the U.S. But that's all I had today, Mike.
Well, I think the whole rail car thing is the system is so messed up that the Canadians don't want to lose their cars onto the U.S. systems. So they're probably, getting them to border point reloads and getting them turned around.
Yeah, and I'm going to go back. I can't stress this enough. If you have the time, please register for this. And even if you can't watch it live, if you register, you'll be able to watch the recordings on all of these. But this impacts, again, whether you trade futures, you don't trade futures, this will impact our industry, hopefully in a very positive way. But if you want a clear comprehension of what's going to take place and kind of the dynamics involved, then I highly encourage everybody to listen to this and, more importantly, participate. Ask the CME questions, very specific questions, and let them give you answers, because these are the people that wrote the new contract.
And I want to just say, this contract going to a truckload contract makes it so much easier for you to really dial in futures to your inventory.
Absolutely.
Previously, a small, say, lumber dealer or home builder, they would have a hard time with the logistics around getting in and out of a futures contract that was a rail car, and maybe they wouldn't use that much material. But from a usability standpoint, the new contract will be much more attractive to almost everyone in the industry.
Yeah, no, I think it being a truck-based size, and then the inclusion of other species, I would say for everybody that is negative or questions this, it's probably 10 to 1 with a lot of people that don't participate today showing interest in at least looking at a futures program moving forward, because it's truck based. Because legally, look, if I'm a producer and we produce this and it's legally included, that opens that up. And then for a lot of people, look, they only trade trucks. So this becomes a lot easier to quantify the risk versus today's car. So again, I'm fingers crossed. I think this is going to be a very positive thing for the industry as a whole.
Yep, and we'll do, is once this new contract gets launched, should we start watching it? And I know I need to understand a little bit more about the pricing and see how it's going to price. But when I have that comfort level, then we can really start talking deeper onto hedging strategies and what spreads are out there. Because look, the contract is still going to be 2x4 random, number 2 and better, spruce or Doug fir. But if you're using, you need to hedge studs, there's a spread, there's a basis, there's a difference between those prices, and monitoring that basis can be very profitable. Knowing when you should lock in the proper spread for a project that you might have coming up. Absolutely. So we'll cover that. I feel like our listeners are getting smarter and smarter by the day. The questions that we get asked, that I get asked, I know people are definitely catching on. So we're excited to be able to put this material out here for you.
Yeah, great. No, again, anybody that has any questions or wants this information, reach out to Mike MX, reach out to me, and we'll forward this on where, we'll put you in contact with the CME, register. You can, if you can't watch it real time, then you can at least watch the recordings, and we'll put you in touch with the right people to ask questions within the CME.
Absolutely. So, all right, let's sign off. Greg, thanks a lot. And next week we can have a little chat about what we've learned in lumber deliveries today.
Yeah, perfect. Hey, Mike, stick around once we sign off here.
Sure. All right. Sounds good, everyone.